Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, August 5th, 2026. It's 10:20 a.m. Eastern Time as I'm starting the video, so we're a little less than an hour into the trading day. What I'm going to do with this one, just a little bit of an eclectic mix. From time to time, I like to go over some of the comments, questions, and my reply or some things others posted. Surprisingly, comments have been pretty quiet lately. We've been hitting price targets like popcorn, so hopefully you guys are doing well. I'm gonna just go through these in reverse order. I see a new comment here on the GDX trade, and let's see. I didn't see this one earlier today. Oh yeah, I thumbs up. That's just someone still holding on to GDX. And I just want to, the next couple comments back here, I'll get to kind of what I'm doing right now, my thoughts, where they are in the market, where the opportunities are. And that is a theme of harvesting profits. If you've noticed the posts coming out lately, you're seeing a lot more trades hitting one or more, a lot of them hitting final price targets than I am putting new trades out there. And so I'm going to get to that in a second. GDX, for example, about 2 weeks ago when GDX was bouncing off the lows and gold was bouncing off the lows, and we had that initial pop that I was expecting when we hit my final targets on gold. That was down here. That was when T2 was hit. So we had a quick bounce, double-digit trade, whatever that was, 24% pop in GDX. And then it came down here again, new trade, new divergence on the 60-minute chart. And I made very clear, I think I repeated like 5 or 6 times in that video, that I still very, very much like this trade. It was one of my top, one of my favorites, and starting to move now. And you can see today, and the reason I'm doing this update, of course, you got a post. We've taken out the bullet. We had the small bullish falling wedge. That was our entry point on the most recent setup. You had the positive divergence, continued to maintain it a buy down here with gold also on the buy zone. Remember, this isn't rocket science, guys. Gold, GDX is going to follow its big brother gold. It's just going to move in a multiple thereof. So you can either make, 5%, 10% on a swing trade on gold, or you can make 20, 30 on GDX, up to you, with few exceptions. Because GDX are mining stocks, sometimes they'll underperform, but that's very, very rare and atypical. And then I wanted to point out too that gold has broken out, so still like them. Probably will add additional targets. The targets I gave you on the 60-minute chart are just that. Remember, all trades are commensurate to the time frame. We're gonna here. Let's get back to this. I just wanted to say that gold, silver, GDX, still like them. Not closing those guys out. Let's talk SPCX. I got crickets on this one. This is one of the biggest hyped IPO in the history of the world, from what I understand. And I had a couple people ask about it when it first came out, and I said I wouldn't touch it. There was no chart. It was overvalued. But waited. I use the analogy. I love watching Animal Planet, and that's kind of my thing. Those shows, anything science-based, nature-based, and you look at how the cheetah or the lion hunts, or even a leopard. They sit, they wait patiently. They're watching that whole herd of gazelle or wildebeest come by, but they're very selective. They're going to pick out that one that's got the broken, damaged hoof, limping along, sick, weak, or the baby that kind of strays a little too far away from mom, and then boom, they jump in, and that was our opportunity on SPCX. But what I wanted to share with you guys, this is just a quick takeaway. So on yesterday, gave you an update in the morning because they were going to report, and I've shared this strategy over the years. But guys, again, the takeaways from this site, other than trade ideas. And again, we've been hitting, on firing on almost all cylinders lately, are the little things I've learned over the years. And this is one of, I just love this tip. And I've given it for years. I've used it for years. I told you, my plan. If you track the post yesterday in the morning, I said if I did get up, my current plan was hold out for T5 and use my OCO orders. One cancels the other. And again, if you go through there in this, I'm going to show you how well this worked. Using on OCOs, you have one cancels the other. You have a stop loss and then a sell limit order, your profit taking target. And I always, especially on earnings, allow those to be filled outside of regular trading hours, but do not allow the stop loss to be hit. Or you'd have to use a stop limit in after hours. Because again, I want that post earnings noise, which I call it, usually a big sharp move one way, which is often reverse. Sometimes it goes the other way. I want to use it to, my goal in any trade is to not be stopped out, rather to hit my price target. And I'm going to just show you an example there. So now I went on to say, now look, if we got close enough by the end of the day around T4, yeah, then I'd close it out. And that's what I did. And hopefully those of you that took it, 1 week, 14%, you do that, you can do that twice a year, you're beating the market. But let me show you what happened with SPCX after hours. This is interesting. You guys might have watched it. So I toggled on the after hours pre-market trades. So if you happen to say, you know what? All right, Randy, you took profits at T4. You wanted to be safe, not risk give back. I'm gonna hold out for that T5 target you gave. I'm gonna shoot for the top of the zone. Look at this punch through right there. So the initial reaction. These are, no offense, but the idiots that, people and it could be algos, but it's usually humans. They see a blowout quarter, 90% growth in earnings, and they buy it. So the initial pop you got right there. So we bought this stock right here, hit that. It was, I think I did a chart for you. Let me pull it up. I can tell you, it was an 18% from our entry price. 18%. So we bought it virtually at the lows. It double tested those lows, still a divergent low, then broke out. If you missed the first time, we had a quick pop to T2, quick profit taking opportunity, could have recycled in. If you did that, then you did better than 18%. 18 is just from where we bought it to where that final target was hit. But look at the sidestep. Once it hit that final target, and we've had quite a few trades lately that to the button have hit the final price target that I gave in reverse, just like this, and that wiped out. It took it back to about exactly where we entered the stock right here on this bullish engulfing candle I posted for you back so a week before yesterday when they reported. And so that's it. Now, as I said in that last update, and again, I just want to go through these updates. I'll sit back, just like the patient cheetah, in the savannah out there in Africa, waiting for the next opportunity. Because if that cheetah ran at every gazelle that walked in front of it, it will die. It will die from starvation. It burns energy, chasing everything that walks in front of it. So it waits for the right animal to be the right distance. It's all about in nature too. If you read about cats, they have different kill rates. Some are more successful than others, but they have a certain kill rate. And if they don't maintain that kill rate, that species, they're going to die, expending energy, chasing after something they don't catch and eat. So same way with trading. All right, so that's that. Anyways, kudos to those of you that caught any or all of that. Did the same thing with IBM yesterday. Revised, booked it. And again, what I'm doing here, guys, is just letting you know my thoughts. What I'm doing is what this, it's not a follow me site, but I provide technical analysis and I'm sharing, what I think is going on right now. And so what you're seeing, if you look back, and we're going to do this a little bit here in this, you're seeing a lot of trades close out recently, long and shorts. A couple weeks ago, it was shorts. I told you we'll get to QQQ in a second. SOXX. We had QQQ hit T2. I told you bounce was expected. Reaction was likely. We got that. Certainly got that. And so I am redeploying and started to yesterday and today. Going pretty, putting a lot of those, the short exposure on the semis and the NASDAQ 100 back on that I took off recently. And you can see it's by design. I know you guys are paying for trade ideas and market analysis, but I'm not going to force it. So you're not seeing as many new trade ideas, especially on the long side, because I'm not finding the type of trades that I'm comfortable with. But again, we already had them. We were in front of these. We were buying IBM before it bottomed, and I revised that final target to the gap. But look, we hit that T1. And so on those that I have closed out early, they went on, and in most cases, another one that comes to mind, again, just recently one of many, Progressive. We hit that, we bought it down here somewhere off the, lows at support. We went up, we hit my first target. At that point, to be safe, I decided to remove the official T2 and 3, but you can see it went on to perfectly hit that T3 target and then pull back. And so that's the common theme. These are where I'm going, guys, is these a lot of these stocks that we've been trading long, and it's by design. I don't like labels, but I'll use labels. I'm viewing a lot of them as bear market rallies. Even those packaged food stocks, we still have quite a few. A lot of them hit their final targets. We got dividends paid on them as well, double-digit gains. I'm talking like Kraft Heinz and, and the likes of those. Some of them are still active trades. Some haven't hit hard targets. But even those, looking at bear market rallies. And this kind of behavior is typical of bear market rallies. You get these quick pops. Trading a bear market, very, very few have the skill set to do it. Most get clobbered in bear markets, but they're more profitable. And again, I'm putting a label here. The stock market just made new highs. I'm going to address that. But the things we're trading didn't, including the NASDAQ 100 and the semis. And again, bear market, bull market, it's all semantics. But this kind of behavior, these smackdowns after these projected targets are hit, is more indicative of bear market action. And again, we have definitely a bifurcated market right now. The major indexes, due to just a handful of stocks and the financial sector, are going to new highs. Financial sector, remember, had a lot of deregulation with the Trump administration, but those are very much in my crosshairs. And again, here's the common theme I predicted in the very beginning of the year. I think it was in the first week. Stated several times since, it'll be a stock picker's market this year, and it most certainly has. Getting in, getting out, hitting 5, 10, 15, in some cases 80, 100% on some of the trades we've had this year, and get out real quick. You're going to vastly outperform the stock market. All right, a couple other things I want to show you. So let's go back to the site. All right. So again, let's get to some of the questions here. And this one, I think, kind of addresses what I just said. All right. So somebody yesterday said, I'd imagine there are very large divergence on every major index hitting new highs today. And, a lot of them did. The ones that the media likes to quote, usually the S&P 500 and the Dow. The Dow, to me, is still, I've always said for years, a joke. It's an antiquated, extremely antiquated index. It was the original one. It goes back over 100 years. But you have a basket of just 30 companies. How representative of both the economy and the stock market are 30 companies? And even then, you have it's a price-weighted index, which is I don't want to use the R word because that's not appropriate anymore, but we'll just say ridiculous. That just means and there are stocks in there. If you have a stock with an $800 share price, it has 10 times the weighting as a stock with an $80 share price, but the stock with the $80 share price could be a $2 trillion company, and the one with the $800 share price could be a 500 million. One's not going to be in the Dow at that, but you get my point. So it's just a stupid index that they continue to quote. Again, with that price-weighted performance, it just makes no sense. It's not indicative of anything but its own index with its own quirky, again, antiquated methodology, if you will. So, but here we're going to talk about this. So as I went on to say in that reply, here's the thing. Yeah, we had the Dow and the S&P hit new highs. And yes, they did very much had negative divergences. But if you notice, and I pointed it out, the Nasdaq hasn't. Now I've had this for a while here. This was created, you can see, back on July 10th. Every time I move it and drag it, it gives an update. But July was back here. And I have this on the NASDAQ too. It's my alternative scenario. I told you, and I'm very clear on this. When I give you an alternative scenario, I'm not the guy that's going to tell you the stock market's going to go up or it's going to go down, or any stock. If you pay anybody for this type of analysis, I'm sorry, but you're wasting your money. My alternative scenario always takes us to the same place. It's just a matter of, do you go down first without going up a little, along the way? If you ultimately go to the target, in other words, the example I use is QQQ. QQQ is the active trade. We're not trading the S&P 500. I'm not doing that because of the financials and other things. In fact, a lot of the longs that we have, let me tweak this line, come in here. It's actually a little sloppy. Let me just take it off on the 60. It shows better on the daily. So here's how QQQ is played out. The initial short entry was right here. Was posted as first a setup with a break on this trend line, then a secondary and confirming sell signal to come under the break of the lows that day. We hit my first target. The reason multiple targets are listed, this can be found on the FAQ page on the right side of the chart, because upon the initial tag of each target, a reaction is likely. So you got a reaction. Then you hit T2. And you had my charts from when this setup was first posted. You go back onto the site, home, posted that yesterday, QQQ update. This was our setup, posted on the 60-minute chart all the way back on June 1st, just before the market's top. All charts are time and date stamped for accountability, and kind of so when they were taken, when the screenshot was taken. And you're going to get little moves along the way, but that's that first big reaction. And that's exactly what we got. So we just hit T2. Remember, T2 is 664.87 back then, and I still have us going down here. So I just wanted to say that this is a trade playing out perfectly. And what I'm doing, guys, I'm speaking to the majority. I've done this long enough. I've fielded questions from members on the site for years, decades, really, and people I know personally that in the media just drooling over this rally, citing strongest rally, several day rally since God, what did they tell me? 2020. You'll have to look it up. It was in the media yesterday. I glanced at the headline, but it's so funny when I hear those headlines. And do this yourself. Pay attention. The biggest rallies in the stock market, in any index, in most stocks, 9 out of 10 times they come in bear markets. 2020, we had a bear market, last one in 2022. So just keep that in mind, that's when the biggest streaks in the index or in individual stocks, or the biggest single day pops come in bear markets, because you have a combination of short covering as well as natural buying, and you have that volatility. Again, I'm not saying in the NASDAQ and it's not in a bear market. It's in a near-term bearish trend. We shorted here. It's zigzagging down, and that's all it's doing so far, and I still maintain T4. What hasn't waffled, I've been talking about this alternative scenario for a while. The S&P just did it, but we're not trading the S&P. I'm not. Nor has it been an official trade idea on the site for a while. So if we happen to pop it, it will be, as I've said, and I drew these lines out in the last few weeks, that it is guaranteed. It's not I think, again, if it happens soon, if it doesn't happen soon, if we went sideways for 6 months, the charts are going to look different. But anytime soon, these indicators are lagging to the point it'll be guaranteed to be a divergent high. Does that guarantee that we go down and hit my fourth target? No. But it certainly increases the odds, as I often talk about, and the reason we shorted here, breakouts that occur with negative divergence, which we did have there. That was the divergence right here that I'm boxing on the daily, lower lows on the indicators, higher highs and prices. That was that 60-minute wedge. and we played it on the 60-minute time frame, at least our targets. And so that's it. You've got a pretty steep uptrend line right here that should do the trick if and when broken. You've got a very high level bearish PPO crossover pending. It hasn't happened yet, but look for that bearish PPO crossover. You kiss the overbought reading, and if we're going lower, if this breakdown was the start of a 15% correction, like I think it is, then we're probably at the tail end of that. And I can tell you from just a pure price perspective, I told you the other day, this was objective to short on a back test of, let me get the right tool, of this downtrend line. That's not the right tool. Let me change my color tool 1 second here. Color to this color here, you can see better. Okay, I'm going to zoom in. And it was objective. We went a little higher. That was a short of that trend line. This is really nice price resistance. You had an all-time high. You had a breakout above it. And you can see what I'm circling, all the reactions, all the candles that occurred, especially the most recent candles. I always put the highest weighting. So we're at resistance again. And we flipped this PPO indicator, has crossed down below my threshold that delineates bull and bear trends or corrections. And that's it. So I just wanted to reiterate, if you covered when T2 was hit, again, we can go back to that right here. On the day it was hit, July 29th, just recently. Seems like forever ago, but it's very clear. Reaction was likely. You had a bullish falling wedge. You had positive divergence. And that's what you get. And in bear markets, those are really good for counter trend trades. Very profitable trade. Again, carried a bit higher, but not too much. To take the measure target of wedge, you take the widest point of a wedge, add that to where it breaks out. That's your measured target. This one carried a bit higher. We carried to right here. So that's it. And again, the common theme is when you go back to the site, you see a lot of trades being closed out recently, hitting targets. Let me close that. And I'm looking. I look every day, and I've trickled out a couple new long side trades, but we still have quite a few active short trades. And I'm talking in the index. Remember, commodities, they're holding gold. That's a whole different thing. I'm doing this. I think shit's about to break. I told you, I encourage you to read into what I posted in the weekly update about Bessent, Treasury Secretary Bessent, buying yen the first time since 1998. For those of you that have been around, I believe it was since 1998, the Asian contagion. It's the first time in years, it was at least 15 years. And what the yen intervention was, did quite a bit of reading. But I predicted, I told you guys that, remember, for about 2 months now, talking about treasuries. It's all about treasuries. For those of you not familiar with the financial markets, when we did this, in the videos, I discussed it. That was a breakout to multi-year highs. That took treasury yields out above the previous highs over the last couple of years to levels not seen since back just before the global financial crisis in 2007. But I told you explicitly there would be a full court press at the Treasury Department and or the Fed to foil that. And they did. And they did it again. This time they came in with the heavy guns. And what they did, just so you know, so Randy, what does buying yen have to do supporting the yen? Japan's the biggest holder of U.S. Treasury bonds, and for the yen been crashing, and it was predicted in the charts too. Remember that too was not some random thing. Call this right side of the chart because I'm trying to look to see what tomorrow's news is going to be. When you buy a subscription to the Journal or Barron's, you're going to get yesterday's news. What just happened. And so we were on this, like white on rice, the yen pair, US dollar yen, it broke down, gave you a sell signal, started crashing. Then it took out the secondary trend line and it hit exactly where my target is. This is where they supported it. But I believe, and I've read, these things are usually temporary. could last months, but it's also a measure, it reeks of desperation. And again, the takeaway was, so what the U.S. did, what the Treasury Department did, is they actually sold euro, not U.S. dollars, because they don't want to. They're trying to. It's all about foiling the breakout in the 30-year Treasury bond. If you read up on this, that's predicted. So I feel strongly that market forces are almost immutable, and in the short term, if you have enough money and enough powder in your gun, big enough barrel, you can, and that's what they did. They can temporarily try that. They're pushing right now. Besson's pushing on the Fed, who's supposed to be apolitical and only support the U.S. economy. It's out of their purview, and now they have invoked a rare power they used during COVID to allow Japan now to borrow money from a Fed window to help support the yen as well. It's all about, again, if otherwise, Japan, to support their crashing yen, has to sell U.S. Treasury bonds. That's all they have. They have so much of them. And by selling Treasury bonds, you cause bond prices to go down, yields up. So make no mistake about it. And again, I think when you're seeing this is kind of desperate moves. And short term, I can't tell you if it's going to work for a day, a few days, a few weeks, a few months. But ultimately, the problem exists, and that is Japan is saddled with debt. We're in bad shape. You guys read about our overspending, our deficit spending, both sides. It's not even anymore. Republicans are the party of fiscal discipline. That's yesteryear crap. They're both, like I've said many times over. Trump is every bit a spender as Biden was. They just spend on different things, and then and the predecessors before them. So you got Congress spending like drunken sailors, and again, it's worse in Japan. So Japan's problems are our problems, because Japan, to fix their problems, their debt's so massive, and now they're having to support the yen. And based on this chart, that was a big divergent high. If this support level breaks, then you're going to go down. All I can tell you is that was a sell signal. That was a sell signal, but we hit support, and again, the Fed. To do it, they sold, it was euro that they sold in order to buy yen. And the euro, as I showed you recently, that was also poised, put in a divergent low, hit this trend line, broke out, gave a buy signal. And so basically, this is the euro-US dollar pair, meaning if and as this goes up, the euro is rising against the dollar's falling. That should be net bullish for gold. So anyway, I'm sticking with the gold and GDX trades for now. May give you additional targets. And remember, the yen carry trade, it initially popped, but it wasn't eliminated when the yen first crashed back here. There was a tech wreck. And what they say is that when you have a problem with the yen carry trade, which is basically, if you're not familiar with it, you can borrow in yen because it's so cheap compared to our rates in the U.S. So the whole trade is borrow cheap, via the yen, turn around and buy U.S. assets, and the most vulnerable culprits are the high, overvalued tech stocks, and that happened back then. And tech stocks got hit hard on that first drop, and that one there. So we'll see. This is again something to monitor. It's not a guarantee anything must happen, but it's something you should keep your eyes on as well. If you want to keep it very simple, you know me, I'm multifaceted. I'm watching a lot of things because one thing relates to another, and that's why these videos go so long-winded. It's not black and white. But all I can tell you is Treasuries broke out. We had a boom, 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 triple top high, breakout. We're currently back testing. And again, there's no bounds. I've learned that after COVID. There is no limitation on what the federal government, including the Treasury Department, what the Federal Reserve will do. The only problem is they don't have the giant bazooka they had when COVID hit because of where we are with rates. Let's just go back there. We had no inflation. Inflation wasn't a problem then, so they could print away. They could do monetary stimulus, which is what they did, meaning bringing rates back to zero, and also quantitative easing, as well as fiscal stimulus, which is sending people checks, spending on infrastructure projects, building roads, bridges, airports, whatever they want, which creates jobs and money. But you're looking at a very dangerous thing. I'll get off that. I've been talking about it. Just guys, remember, it's incremental. It's not binary. I've said that repeatedly. We did break out. It didn't crash the markets because that breakout again got foiled. They're intervening, and they're taking what's in my opinion extreme measures. Now I can say this too. I think a great trade. We've done this at least half a dozen times in the last couple of years. So I'm going to say it directly. For those of you that are short or reshorting or adding back short exposure or plan to short, it doesn't matter where you are. If you are currently or plan to be short the equity markets or the semis, the things right now, or any of the select individual stocks that we still have as short trades on the site, Carvana, you name them. And I think this is a good time. An indirect hedge would be to go long treasuries, because one of two reasons: either they're going to come in with some extreme measures to try to knock the yield down on the 30-year. Remember, bonds and yields move in inverse directions. If they can bring the yield down on the long bond, prices go up. If TLT is the inverse, we'll just flip it upside down. Look at that. You've got positive divergence, and now the thing is, if treasuries continue to go up, you're going to lose on that long on TLT or ZB, the bond futures. Rates are going to rise, but it will crash the market. So your stocks, especially the high-flying techs, the semis, are going to go down. And we're going to get to that in just 1 second. So let me see if there's anything else I want to cover, and then I want to get semis in the market, and we'll wrap this video up. All right, so this is the one I was covering. I addressed the fact that, the market that matters to me, and the reason, and again, this is just in my opinion, the NASDAQ 100 is the most important index, and it wasn't even close to new highs. I went on to say, I looked at the equal-weighted NASDAQ 100. I looked at the NASDAQ composite. For those of you not familiar, the NASDAQ composite are all the stocks. There's thousands of stocks in the NASDAQ composite. It's very tech-heavy. The NASDAQ 100 is just the largest 100 of them. And that's the one that the ETFs and most index funds will trade and track. And so that's it. So that one failed, has not made new highs, which should be maybe a bit of a red flag. You can even go back. It did the same thing back here. Right before, here it was, our bear market in 2022. It made a new high right here in late November. Failed, made a slightly lower, but failed to take out that previous high, while the S&P eked out a new high, just like it did now. Then came the drop. And so that was showing you that the most important stocks, again, financials are important. They're important to the economy. It's the grease that keeps everything going. We're a debt-based economy. We all know that. However, they don't hold a candle as far as market cap, even in the S&P 500, as this just giant tech machine, this circular trade going on with AI, from the Mag 8 companies, the big tech companies that are doing all the spending, to the beneficiaries such as NVIDIA, who then turn around and inject it into companies like OpenAI and fund these data centers, which benefits the chips, benefits HVAC companies, AC companies. And then again, there will be a point that I can guarantee you that trade goes the other way. There's not a single trend in the history of the stock markets that is perennial, that just goes on forever. So that's it. So let's get away from that. You guys know I'll talk the long-term talk all day long, but it's the charts that are going to position me. And I'm telling you right now that I think it's, like I said, great time as I've been. And it's, again, not even, I've closed a few of the long trade ideas early. If you go to trade ideas and click on the top one, completed trades, it'll show you long and short. And again, a lot of them have hit the final target. SPCX, I told you we were within 2 to 4%, so I closed it out officially at T4. Like I said, if you would have held on, you got the T5, the top of it in after hours, and then you sidestepped the crash, which would have gave back all your profits. That one, when I revised the final target, I closed it out as I just showed you, just a hair below where I was targeting anyways on IBM. Potential is only potential unless I eliminate that word. It's not an official target, so we close it there. Left a fraction of meat on the bone. Doesn't mean it can't keep going up, but that was the final target. So from my experience, when I'm long and I have a flurry of my long trades, that if some have been on for only a week, like SPCX, some have been on for months or several weeks. When I have a lot of those hitting the price targets around the same time, that's usually when, at minimum, there's going to be a correction or the end of a run to the upside. And as you comb through here, you can see we've had a lot of trades hitting one or more price targets. And then remember, a couple weeks ago, no, I'm sorry, yeah, just July 29th, this was the very day that QQQ hit that T2, and I told you I expected a reaction. It wasn't just QQQ. As I told you, a lot of the semis, I did a video, including SOXX itself, were all hitting collectively price targets that I had. And I even drew the arrows in on that post, expecting, where is it? Right there, expecting a bounce. So I just wanted to convey that don't get tied up. It's not to say we can't go to new highs in the S&P 500 or the NASDAQ 100, but don't get tied up in the strength of the rally in the last couple of days, because I expected a rally, I expected a bounce. These weren't just random. These were good, really solid price targets. And it wasn't mere coincidence that exactly when T2 was hit on SOXX is exactly when T2 was hit on the QQQ 60-minute chart. And we had positive divergence. But remember, SOXX gave me multiple sell signals recently. It started out here on the weekly chart. We had a break of the uptrend line off the key March 30th lows on the weekly chart, and a bearish engulfing candle. And then the bearish PPO crossover I was looking for followed. And we haven't hit my targets. I've been calling the semis unwaveringly down to the 200s in this trend line. So I think there's another leg down. But guess what? Like any trade, it either works out or not. So we've been batting 800, 900 lately, but not 1,000. And so if you have all your money in this trade and you're holding out for the 200s, you may never get there. We already had, we were short for the biggest drop in the semis in years, but it's also, like I posted in the update, they're still up year to date, pretty healthy. I just think that, here we are, we're at resistance. We're back to the T1. Remember, the way my targets work, there's support. And support, once broken, then becomes resistance. So when we hit T2, we got the bounce as expected. We bounce back to both the 50-day moving average and T1. Okay, sorry, I had to take a phone call there. It's about a 10-minute pause. I'm trying to collect my thoughts where I was. Despite the fact I think there's going to be another leg down in the markets and the semis, those two collectively are not only just two of many trades. We still have plenty of longs and shorts in niche sectors and other industries out there. But QQQ and SOXX are very, 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 very much overlapping trades. Remember, the NASDAQ 100, most of the components of SOXX are in the NASDAQ 100. So without further ado, let's just rifle through there. Let's start with the top components of the Qs. And I'll go through the top components of SOXX, and we'll wrap the video up, and then I'll do what I do, which is continue to hunt for new trade ideas and opportunities. So quick recap of QQQ. As I showed you earlier, it's at really nice resistance. Was it resistance the other day? That was an objective short entry. Just because we didn't reverse doesn't mean it wasn't objective. Shorting on a kickback to a downtrend line is always objective. We had a bit of a momentum fueled overshoot, but we're at really nice horizontal resistance. We're also at the 76 fib. If you put up, this is my fib board here. Fibonacci retracements are a big part of my trading. I like to incorporate them. That means that was the all-time high, right where we, this is where we shorted, just on the breakdown below there. And this is the recent low. So if you measure from that point, from that high, which this line is, down to the bottom, it shows you the retracement. And these are your key fibs: 38, 50, 61.8, the 78.6 is a fib. That's where we've carried up to. So on the stronger end of bounces, again, it exceeded by a little bit how far I thought this bounce might go. And again, there's nothing to say it can't go higher. If it does, again, I want to speak to that one more time on this trade. There's, the expression, there's a dozen ways or whatever it is, 100 ways to skin a cat. Well, there's 100 ways to trade the market. You may have had your eye on the prize, I call it, where if you shorted there and you said, you know what, I'm going to just tuck this thing away. I agree with Randy. I think we're going to go down to this fourth target zone. We're going to have that 15% drop in the NASDAQ. So you're still profitable, because that was our short entry throughout all this. And despite this, one of the strongest rallies in years, over just a few days, again, predicted rally, not the full extent of it, but that we would bounce off that level, you're still profitable. We're still zigzagging down. Now, as an active trader, and we'll do, if you gamed any of these bounces, if you booked profits at T1, waited for a bounce to recycle back in, or even better, reversed it, gamed the bounce, and then did the same thing here, instead of a 15% profit, if that hit, that could be a 50% profit. If you add up, again, it depends on how much, if any, that you milked. I usually will, take profits and then start adding that back. And I've kept in my long-term accounts, I've kept core short holdings, but I'll reduce them and then scale that, add that back in. And so I just wanted to point out that despite the media headline sensation of the stock market making new highs, the NASDAQ 100 hasn't. And it did something very similar immediately before the 2022 bear market, where it dropped, I think, 36%, something like that. And again, I can't impress this enough, because I get this once in a while, somebody that's getting just killed because they're not taking. They don't want to take, Kraft Heinz. They don't want to take, SpaceX. A given. I told you that was an aggressive catch a fall knife trade, but it was I stated my reasoning for entry. It wasn't just hey, let's buy SpaceX today, but or any of the other things. We have insurance companies, gold mining stocks, on the long side, and dozens of other trades that we've had recently. So just remember that although QQQ, when you buy or sell it, you're buying and selling really 100 stocks, but you're buying 100 stocks that have such a high correlation because of the massive amount of indexing. Everybody knows, it's well documented, this market is now based on inflows and outflows due to these index funds. That's what drives the market, and liquidity. Again, the Fed, if you don't think that the Fed and the Treasury are backdooring right now, flooding liquidity into the banks to get the banks, the primary dealers, to buy stocks, and part of that contributed to this. They're supporting the yen. They're doing everything they can right now to keep the shit from hitting the fan, and that is a sustained breakout or a continued rise in long-term Treasury yields, which will just cripple the market, and it'll blow up the AI trade, because a lot of that stuff's heavily financed, all the data center build-outs and everything else. Okay, let's move on. So QQQ, let's just talk the big Mag 8s, and we'll get to a few semis, and we'll wrap the video up. So no sell. I've been highlighting this level, the purple line in NVIDIA. Support is support until unless broken. If I've said that term once, I've said it 1,000 times over the years. And so far, NVIDIA continues to hold that key purple support level I gave you. And unless it breaks down, the NASDAQ's probably not going to go and hit my 15% downside target. So we bounced off there. It's just another reflexive bounce. It's still off its all-time highs. And I still expect that. And then when that breaks, if and when that breaks, I will most likely be extending targets. So for it to break, Nvidia now has to drop to get down to my purple zone 14%. It's probably going to pull the Nasdaq down to my T4 level. But if that breaks, and some of these other ones, again, I do this all collectively. It's not any one stock. They're all collectively. I gave you these zones. They haven't been touched since before earnings. Alphabet, like a world champ, hit the 200s. I even mentioned it to you there. If you're bullish on Alphabet or the market, you buy it. That's what traders do. They buy pullbacks, corrections of the 200s, especially the big corrections. So it's a level that I still think is going to go. This was post-earnings noise. There was an earnings right there. We briefly took out the trend line. We back tested it. I thought and still do think this level is going to go. We're back to resistance, not a new high yet. And when you look down below, remember I used the PPO to delineate and identify trends. When the PPO, the signal line, the white line's above it, the trend is bullish. You want to be long and strong. Oops, I overshot that a little. When it crosses, you have your corrections. And in a bull market, so far, the corrections. We crossed here, we had a correction. Now, the correction may be over. These lines are pointing up. We may cross, but we haven't. It's this white line, the last of the two to cross. What happens is once you enter the bearish trend, the zero line acts as resistance. So if we get rejected and we go down, it's going to keep this one indicator on a sell signal. Again, don't get confused because Alphabet's within spitting distance of new all-time highs. That's bullish. The primary, the long-term trend is bullish. But this one indicator right now is in bearish territory. And you can see, that's what happens in a strong bull market, bull run. You're above it, you're long and strong. Then when you start to break down, the stock starts to wobble. You put in a big divergent high, and you'll have counter trend bounces that are going to take you above it, but then you go back down below it. You spend more time below it than above it. And then you realize after the third or fourth time, the stock's down 30, 40, 50%, here, I call it the point of recognition. That's where the bulls realize they've been buying the dip and it's not working. And then you kind of get that last capitulation type sell-off. So anywho, that's just one of many things I'm watching. And just like the NASDAQ 100, any new high anytime soon. Again, any new high anytime soon being the operative word is guaranteed to be a divergent high based on how steep these indicators are lagging, the PPO and RSI. And so, again, to me, it's still a matter of, do we have another little bit more upside? There's a lot of momentum right now, a lot of FOMO in this market, and I see minimal upside. If that happens again on QQQ, it will take the trade. And again, you have to have your own trading plan. Yours isn't mine. I'm an active trader. I tell you what I'm doing. But that was our short entry. T4 is a 15% profit if hit. So you can give yourself easily a 5. If you just shorted there and you're holding out for the prize, a 3-to-1 risk-reward ratio means you'd give yourself a 5% stop loss. I have to drag this here to show you how high that would be. So from our short entry point, I'm trying not to move the lines here. Oh, I can do it this way, turn everything off. So from where we broke down, if you look at the pop-up box, 5% is right there. Be about 778. All right, 778.21 is 5% above where we shorted. So that's a 3-to-1, which is a very attractive risk-reward ratio. And that would be up there. So that would allow for a marginal new high. And again, that's more of a trend trader. I'm what I call an active swing trader, where I like to game the little counter trend bounces within the bigger trend. All right, now let's cover a few more of the Mag 8s. Apple still called that one down following earnings, still below, testing its 50-day moving average. And this is where it's lights out. Apple loves its 200-day moving averages. That's one stock I've traded it for many years. And it just does a good job. In a bull trend, you want to buy pullbacks to the 200s. But when the 200s are lost, that's the Scooby-Doo rut-row moment. And what you do is you start shorting rallies back to the 200s. until they're regained, as they were right there. So Apple, it's coming off a divergent high. The charts project a lot of downside, and this was back, created that back on July 16th, which was right here. I'm doing my crosshairs. I'm looking at the pop-up box to the left. So right here, I said watch for a wedge break, which we got. There was a break of the wedge. It back tested the wedge. And then a failed break of 316.92, which would mean this breakout to new all-time highs failed. That's what happened. So Apple, check. Now, it's just a correction at this point. This is when it becomes something more. So let me give you, I'll add to the Apple my purple zone like I have on the other stocks. So I want to see the 200s, and it's also nice price resistance. This was pretty much the all-time highs. There was a failed breakout attempt, tried it again, finally broke out, successfully backtest. To me, that's a very significant level. So there's my purple box. And again, these are probably going to come into play if we get there around the time, if and when SOXX and QQQ hit my next targets, right? If Apple's going to do that. And it could do this first and then that. Microsoft held support. The purple box there popped above this one, popped above the 200s. I give this one points. Hell of a rally, but big resistance right now. We went long Microsoft right here on this bullish falling wedge breakout. I gave you a total of, you can see back then, 3 targets. 1, 2, 3. I called it in early when T2 was hit. I said, let's take that quick, whatever it was, 10%, fit 12, I don't know. You can look back on that trade. And I eliminated T3. But T3 back then was resistance, and it still is. And that's a big resistance level. And to say the stock is overbought is an understatement, because on Microsoft I have, and I've had this line here for a while. You can see since July of 2021, what that yellow line is that I'm highlighting, 78.64 on the RSI. The RSI indicates how overbought or oversold a stock is. I'm going to squish it up so you can see it. And you can go back as long as you want. It doesn't get there very often. It's what I call my extreme level. When you hit it, there's usually a big correction or a bear market. We didn't hit it there. We didn't hit it there. I think we fell a little shy there. And we went on to put in a divergent high. The stock went sideways and then down for a while right there. We had an extreme persistent, but there was a correction. Remember, I call these bear market resets. When you get after a bear market or a big correction, you get a reset, all right? And you're going to get overbought and stay overbought for a while. But what happened? We continued. We pushed that overbought reading right there, and that was the top. Proved to be the top. We made an equal high, and it was also divergent high, so it worked. If you shorted there, you never went underwater. It just took a little while for it to play out. And then you had one of the biggest, most profitable trades on the short side, a 36%. The stock lost a third of its value. All I can tell you right now, we're back to that level. And God forbid it's a bear market. God forbid that was a top. This is a gift wrapped up with a ribbon, wrapping paper. In a bear market, when you get an extreme overbought reading like that, and that is indicative more of a bear market rally, in my opinion. And remember, let's not forget, this one I was bullish on back here because we had the positive divergence right there at the low, and a breakout above the downtrend line. So the rally was technically induced, but it's coming off a much bigger divergent high on the daily and weekly charts. Amazon, big divergent high. There's a case of a stock that did go on to make one of the few Mag 8s, and it put in this high was and is a divergent high, and because of that, I put a high degree of confidence, just based on experience, it will fail. Because from my experience, breakouts that occur with negative divergence and overbought conditions usually fail. At least 80% of the time, if not 90. Divergent high, new high, correction. It's just the MO of this market, and it ramps up. The retail crowd gets excited. They start chasing, and the smart money, the institutions, they sell into that high, and then you get the corrections. So, Broadcom, Still holding my purple level here. Needs to take out the 200-day moving averages. Needs to flip this PPO indicator. I have the PPO at negative 2.51. That delineates the trend on Broadcom. So that one's still no sell signal there yet. I'm waiting for this to flip below 2.5, the PPO, and I'm waiting for the 200s to get taken out. Meta coming off a divergent low, but still below its 200-day moving averages. See positive divergence, at least on the PPO there. And but all the while, turn off all the lines, this stock lost its 200s here. It's whippy. It had a false breakout. I addressed it at the time there, and it failed it. And every other attempt, and there's another failed attempt. So you got to give this one a little room. It's just the nature of this beast. It tends to have a few whipsaws through. But again, if you go back over time, generally you'll see this, like many tech stocks, the 200s define the trend. Bear trend when you're below them. That's just, once you lost them here, the stock fell 73%. Not from the highs, but from where it lost the 200s. It lost the 200s here, and every time it keeps trying to get above them, even if it does for a day or two, it gets smacked down. So that's the state of Meta. Tesla, I told you guys you could bounce it. It was extremely oversold. I said bear market bounce, but highlighted this extreme oversold reading. Told you last time it got that oversold. Had a nice bounce. But that's all. This broke major sell signal when that yellow uptrend line was broken. So Tesla, I think, is going a lot lower. 56 minutes. We're going to just look at the semis this way. I'm going to show you that, again, I already covered T2 was hit. We bounced back to T1. Objective short entry yesterday and today again. Because we're right there. We're right on the level. About 533, give or take. Remember, I've been waiting for a bearish PPO crossover. Bingo, I have it. My level is at negative 1.23. Again, I do not go off the default zero line. I look at every chart and I analyze it specific to that particular security, be it a stock, an index, an ETF. And in this one, the negative 1.23 level does a great job in a bull trend. It acts as support on pullbacks to it. You want to buy, and it tells you you're in a bullish trend and you want to be long and strong. But we had other sell signals. It's not a be all end all, but it's a pretty good trend indicator. And you can see right here, you cross below it. I'm going to measure from the drop when you cross below it. The semis fell 26%, and it marked that whole bearish trend was marked there. So that's in play, and that's why I still maintain deeper targets on the semis. To go through them, let's just do this other way. The video is getting long, so I'm going to flip to my fib board. Fib board is where I have Fibonacci retracement levels, and I'm just going to show you that how things look here. So from the recent highs to lows, what's happening here in the video is backwards. There's all right. I so did that wrong. I had an old fib here. This is the recent correction right here. From the highs down to lows, there's your high. We're right on the 61.8 fib right now. Again, these are typical retracements. Sometimes 78.6 I'll put up there. I just happen to have these other fibs from previously. So it's showing me that right now these are nothing more than counter trend bounces in the semis. Taiwan semis at its 50%. Again, I'm measuring from the highs to the recent lows where we hit T2. Remember, not mere coincidence. It wasn't just SOXX and QQQ. I had covered that day in the video. A plethora of the semis within here were all hitting price targets that I had at the same time. So the bounce was expected, and so far, again, this could prove to be, hey, that's it, and we caught it, but we should have, covered everything and gone full long and held on. That may prove to be the case. It's not what I expect. I'm showing you right now. These are just run-of-the-mill counter trend bounces, as strong as they might appear. Remember, everything is relative. When I say it's relative to the scope of the move. Bitcoin and the semis and GDX, they move a lot more than Treasury bonds. So the trends, even the counter trend moves, whether it's a bounce in a bear market or a pullback in a bull market. They're big in percentage terms. You just have to frame it that way, and that's what fibs do. They help you kind of put it in that perspective. So right now, from the highs to this low, this is just a 50%. We've just bounced back halfway, and that's a key fib. And this is the usual typical in a counter trend move. Typically, it's in this range from about 38 to up to 61.8. That's again an average counter trend bounce. So that's all that is so far. And I'm just going to click through them and just tell you where we're at. You can see, you can stop the video. We're hit the 50% fib to the button on Broadcom, again, from the high to the recent lows, 50% retracement. Micron is at the 38.2 fib, pretty weak bounce so far. AMD just kissed the 61.8 fib, and again, you can see the highs right here. Hit the 61.8 fib. Rejected so far. ASML 38.2 fib, minimum, just a regular counter trend bounce. This one I had the 23.6 put on. Let me take that off. I usually don't keep that one on there, but very weak bounce on Intel so far. And remember, bigger picture too. I called this one, that divergent high, said that would most likely fail. The breakout would fail, and then if you wanted to be safe, wait for break of the trend line, and then we'd go to the bottom of the trading range. Again, this is trading range, and that was key support. We did, then we broke it, and all we're doing is back testing. So again, we're at price resistance. We're at the 50-day moving average, that yellow line right here, which is a bull trend near term. You're above it. So there's a confluence of resistance, both the bottom of the trading range, price resistance, the 50-day, and the, you're not even actually, it hasn't even had the strength to make it back all the way to the 38.2 yet. That's a pretty weak bounce. So that's it. And I can rifle through the rest, guys. I've already looked at them. I'm telling you, they're all at, they're just run-of-the-mill bounces so far. So that's the common theme. I've been harvesting a lot of profits on longs by design. Again, either hitting their final targets or, like I said, in the case of SPCX and IBM, we were 90% to the target. And I didn't want to get greedy, so I closed those out. Sometimes I shear the entire meat off the bone, but sometimes I'm happy to take 70-80% of the meat off the bone, cut it and run. And I'm being selective on longs because I'm just not finding a lot that stand out with attractive risk-reward profiles. So I'm going to wrap it up here. You guys get the kind of the gist of what we're doing. And again, this video was heavily concentrated on the QQQs and the semis, which again are one of many trades. There's still plenty of long trade ideas on there. There's growth and income trades for those of you that don't want to short, don't think the market's going to go down, or don't want to ride out a breakout to new highs in the NASDAQ, even if it may fail, which it may not. So like any trade, that's what stops are for. And your stops are going to be commensurate with your average entry price on any trade. It's not going to be my price. Some trades are cut and dry where I say, here's our buy point, hard buy, it's a breakout. We enter here and we have a sole price target and one stop. Those are easy. But most of my trades have multiple targets because I like to game the zigs and the zags on the way down. All right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.